My next guest says, do not create an investment policy right now that's trying to front-run the Fed. Joining me now, Bahnsen Group Managing Director David Bahnsen. David, you also noted that it's important. It's an important consideration, right, for the Fed with respect to what they're trying to do with these lower rates. One of the things we're looking at is for you is to unfreeze this housing market, this housing situation. Well, today, mortgage applications dropped 21%. They were up a couple of weeks ago. They seem to be going hand in hand, of course, with mortgage rates themselves. Can the Fed help this issue?
This is refinancing, and I really think the bigger issue for the Fed is new purchases.
That was still down 1%, 2%.
That's
so
right.
It's still not going in the right direction.
Because it isn't going to when it still has a 6 handle in front of it. When the mortgage rate comes from 7 to 6.2, that's better. It picked up a little a month ago. But when it's the average mortgage rate being paid in the country on homes people already own is around 3.5%, you're not going to move the needle until you get it much lower.
What about a 5 handle?
A 5 handle, I think, is going to move the needle. I think a low 5 handle really helps. And if you get a high 4 handle, you're probably in recession. I just don't think you're going to get the long end of the curve down enough unless the 10-year is at 3.5%, which would be a disaster. It would mean that this job growth issue really is a big problem. So the Fed's in kind of this tightrope situation.
So let's talk about valuations, because in your note, you noted that there are some pockets of the economy, or the market rather, where valuations are dangerously high. That word stuck out to me. Obviously, there's a lot of ways to monitor. This is just one way, the Wilshire 5,000. What does it mean, though, right? Because we've been hearing this for a long time, you know. I mean, anytime PE ratios get around 22, whatever, you know, a lot of folks, their hair go on fire, and the PE ratio can keep going and keep going. If you're in the market, you know, and you've gotten out because of that, you've missed a lot of this rally.
Well, that's right. Anyone who talks about valuations like I do, who's honest, always says it's not a timing mechanism. It's that your forward return when you're buying at high valuations is going to be lower than when your forward return will be when you're buying a lower valuation. That part shouldn't be very complicated. The issue is how long it's sustainable and how much of the earnings we grow into the valuation. But I think that 23, 24 times forward earnings, when it's isolated to one pocket of the market, that's a huge risk.
Okay. Let's talk about something that's been worrying me. PE, private equity, private credit, alternatives. In part because the way these stocks have acted, you know, whether it's the Apollo, whether it's Blue Owl, which is a name I know that you've liked.
Yeah.
I mean, it's opaque. It's still sort of opaque compared to other asset groups out in my mind, you know?
Yeah, well, I think that there's incredible transparency about what Blue Owl owns, but especially Apollo, Blackstone. Now, remember, Blue Owl is down here since April. Apollo and Blackstone are up huge.
They were down a lot. They've just started coming on.
They were up 100% in the year prior, okay? It was huge returns.
So you don't see any cracks in PE?
No. What I would say is that the danger is what the quality of the assets are that they're buying. Remember, when you're buying Blue Owl, Blackstone, Apollo, these types of names you're worried about, you're buying the fees that they get to manage it. So the investors in the underlying products may or may not like the returns they get. That's not what you're buying when you're buying these companies. Now, I happen to think that those returns are going to be very, very good. Blue Owl is a concern because they have a ton of what's called PIK, payment in kind. About 30% of the loans they're giving out there. And these are big companies with a ton of earnings, over $100 million EBITDA. But they have a high percentage in PIK. It's going to pay out huge if everything goes well. If the economy goes into a recession, that's a bigger problem. That's what the market's pricing in. I'm saying to risk takers with over a 5% yield on Blue Owl with this kind of drop, and they're way below where their peers are. They've raised hundreds of billions. They're doing a huge thing for data center with Dubai. Blue Owl is a very attractive buy if you don't go into a recession.
So just a little higher risk right now than maybe normal. Let's talk about a couple of your stock picks. Pepsi, obviously, you know, you're the dividend cafe master. Elliot's in there, streamlining their business silos. Also, of course, risk reward, right? Because it's obvious that you feel risk is elevated at this point.
And that's the point I'm trying to make is this is not what you want to buy for momentum. This is anti-momentum. But this is if you want a contrarian play with value, that Pepsi, Merck, these are the types of names that are very undervalued relative to their own historical PE ratio.
Let's talk about Merck for a moment. So yesterday, healthcare, you know, just I know you're not a technician, but this is a beautiful double bottom. We broke out through the 250-day moving average on strong volume because of that meeting in the White House. You know, of course, Merck was the number 2 performer yesterday. I know you think that kind of stuff maybe is a little gimmicky. You're more.
Well, I like it when it helps me.
Again, a 4% dividend, R&D machine, 12 PE. Yeah. Again, you sleep. This is one of the you sleep at night, but there's also huge potential upside
with tons of billions billions of dollars of cash for more M&A. They can buy their R&D without having to wait 10 years for phase 3 approval from our bureaucratic Food and Drug Administration. So they really are in a better position to innovate. In the meantime, with Keytruda, they have a staple drug.
All right. Great stuff.
I like the whole space.
Great stuff. I know you do.
All right.
I love our conversations. We've got to make it a little longer next time.
Yes, sir.